in association with Lewtan. I am James Lineker, representing SCI, and I'm joined today by Ned Myers from Lewtan and Steve Coudenholt from Dentons. Gentlemen, would you like to introduce yourselves?
Go ahead, Ned.
Hi. Yes, I'm Ned Myers. I'm a Senior Vice President with Lewtan. I've worked with both issuers and investors in the securitization industry for longer than the last 2 decades. I was instrumental in defining and delivering platforms to meet the requirements of the original Regulation AB, and I'm currently charged with crafting the Reg AB 2 solutions that Lewtan will be offering to the market.
Good morning, everyone. This is Steve Coudenholt. I'm a co-chair of capital markets in the U.S. at the global law firm of Dentons, and I've been involved in the securitization industry for even longer than Ned has, and certainly have been a student of Reg AB and Reg AB 2 all along. My practice group does a lot of securitization, with a particular focus on residential MBS as well as other asset types, and I've been extensively involved in the commenting process on Reg AB 2, most recently a comment letter back in April related to the privacy concerns resulting from the February 2014 re-release.
Thanks, guys. Over the next hour, we will be discussing Regulation AB2 in depth. Before we start, I would just like to ensure that everybody is logged in to the GoToWebinar platform so that you'll be able to follow the slides and take part in our interactive audience polls. There will be a Q&A session at the end, so if you have any questions you would like to ask the panelists, please submit them via the question panel on your screens, as there is no audio link for delegates. Ned, to start us off, could you quickly get us up to speed with the background to this regulation?
Absolutely. Regulation AB2, as the rules have now been commonly referred to, were initially proposed back in 2010. Sections of the rule were reproposed 2 additional times, as Steve mentioned, the most recent being February 2014. On August 27th, the SEC adopted the rules in the same open meeting where they adopted a set of rules for NRSRO reform. The new Regulation AB partially satisfies the Dodd-Frank rulemakings around 939A and 942B, which are, first, the removal of credit ratings from the regulatory framework required for public shelf registrations, and second, to require asset-level disclosure where relevant information for an investor to independently determine the credit quality of an ABS pool is necessary. And the reason I say partially is the SEC did not declaratively say anything about closing the books around additional asset-level disclosure. And in fact, at the recent conference in Miami at ABS East, the SEC mentioned that they are still considering other asset classes for asset-level disclosure. The regulations expanded and clarified areas that were adopted under the initial Regulation AB. And unlike the original proposal that had elements such as a cash flow waterfall disclosure, the SEC also chose not to adopt a requirement that where 144A issuers would need to provide investors with the same type of information upon request as if the offering were a public deal. So with those high-level aspects that were adopted, the timeline for implementation of Regulation AB2, since it was filed in the Federal Register and effective 60 days plus 1 year from that point of filing, the rules will come into effect for U.S. public deals beginning in November 2015, with one exception being that the asset-level disclosure requirements will take effect 1 year later.
Thanks, Ned. One of the most discussed areas of the new regulation has been the disclosure of asset-level information for public issuance, including the notion that potentially sensitive data could be offered for public ABS on an issuer or issuer-sponsored website. Steve, how have the rules addressed these privacy concerns?
Thanks very much. I think it's important to kind of note what the starting point was before this proposal, and that was that with resi mortgages, there had already been a fairly established practice of providing detailed loan level data to investors. whereas for other asset types, such as auto loans and credit cards, there was not any such practice at all. So one of the things the SEC was trying to do with the proposal here was to create a level playing field under which for all asset types there would be a comparable level of asset level detail that investors would be able to analyze and review, and that would be the same for all issuances of that asset type that are issued publicly. And with the initial proposal with loan level data, there were certain elements of the proposal that, even though in some senses following industry practices, given the focus on it due to the commenting process, raised some privacy concerns. For example, with residential mortgages, the proposal included data fields such as loan amount, date of origination, and 5-digit zip code, as well as other data fields that include sensitive borrower information like income and assets and that kind of thing. Now, of course, the original proposal did not name or give addresses of individual borrowers, so you could not directly identify a borrower from the proposed fields. However, it was noted really early on in the process, going back to the original commenting in 2010, that it was possible to essentially re-identify an individual borrower by combining the data in the posted fields with other publicly available information, such as real property records from which one can see a date of a mortgage and an amount of a mortgage, and if you are in the right zip code, you can likely match it up with an individual investor. So in fact, that concern was so significant that in February of this year, 2014, the SEC actually issued an additional proposal, or reopened the comment period, specifically to address a separate proposal under which issuers would provide some of the sensitive data fields on their own proprietary websites, to which they would make sure that there was restricted access to assure privacy protection. So that was the proposal that was considered. Now, how did the SEC basically come out on that? Really, the SEC came out in a different direction because they determined that, first and foremost, the most important thing was that all asset level data that's required under the rule should be publicly available, readily publicly available to all persons, both investors and non-investors. And therefore, they scrapped the issuer website proposal. And one of the things that's really focused on in the adopting release as a policy matter is that if you are an investor in a given class of asset-backed securities, that you should be able to compare the security you're being offered with other securities of that issuer and of other issuers in that same asset class, and that you should be able to do an apples-to-apples comparison across these different, representative securities to kind of glean information about your pool. And in order for that objective to be achieved, it was essential that not only all the data fields are public, but that all issuers provide the same data fields for any given asset class. Now, that still left the concern about what do we do about re-identification. Well, the SEC did two things to address that. One is they made the asset level data significantly less granular all across the board, most specifically with zip codes, reducing them from 5 digits to 2 digits, but also removing individual data fields such as income levels and asset levels, and going in the direction more of ratios like debt-to-income ratios to provide disclosure. So less granular data, but still realizing that that did not fully eliminate the re-identification risk. And so additionally, the SEC, in conjunction with the Consumer Financial Protection Board, worked out such that the CFPB provided essentially a interpretive guidance letter which has the effect of protecting issuers to the extent that they are publishing these data fields in accordance with and as required by Regulation AB2.
Fantastic. Thank you, Steve. I'd like to invite our audience to take part in our first poll. The poll question is, where do you think investors will access the newly available asset level data? The options on your screen are direct from Edgar, via an issuer or issuer-sponsored website, from a vendor, only in aggregated form from a vendor, or the last option, if you think investors will not access this data. Thank you very much. While we wait for those answers to come in, Ned, could you tell us about the new asset level data requirements and how they differ from the original proposals?
Absolutely. Thank you, James. Unlike Regulation AB1, which was largely a principles-based regime, under Reg AB2, the asset level field requirements are all required fields where if an issuer is unable to provide those fields, there's an ability to make a hardship exemption. The data is intended to be supplied and must be supplied in an XML data format, which is effectively a machine-readable format. So unlike a PDF filing or a document that you would read, the data that's supplied by an issuer will be readily readable programmatically by the market. And lastly, the SEC simplified the delivery of the data in a couple of ways from the original proposal to the adopted regulation. The original proposal had the concept of general fields and then asset class specific fields. The adopted version has only asset class specific fields that apply to each asset class in question. So that eliminated a lot of the confusion around fields that were mortgage related that didn't apply in other asset classes, for example. And secondly, the SEC required that the initial asset level data provided and the ongoing data elements are identical. So in consuming the data, I think the market can programmatically write one set of programs for each asset class, and then can expect each issuer to provide all of the required fields in an identical format, both at the inception of the deal and through the life of the transaction.
Thank you, Ned. The results of that first poll should now be available. Please refer to a panel in front of you where you will see that it's quite tight, but via an issuer or issuer-sponsored website seems to be the most popular response to our question. Thank you all very much. Okay, drilling down into mortgages now. Steve, are there significant differences between the SEC's requirements and existing market practices?
Sure. Yes, there are. And I think an important example is that 5-digit zip code. Investors are accustomed to having 5-digit zip code granularity so that they can assess risks, in particular risks of changes in HPA and in particular environmental risks and environmental hazard risks. And by going to the 2-digit zip code, that represents a significant change from existing market practices. 2-digit zip code simply means the first 2 digits of someone's zip code. I live in Connecticut. My first 2 digits are 06, and that I think that there are like 3 or so different 2-digit combinations in Connecticut. Obviously, for the mathematicians out there, you've already gleaned, I'm sure, that there aren't that many 2-digit zip code combinations. There's approximately 100 of them, so that is certainly a lot less granularity than 5-digit zip code. Some other fields were changed as well to mitigate re-identification risks, such as removing sales price of the property, property value at origination, origination date and first payment date. These are removed to help kind of further make it difficult to identify the asset from property records. Also information about the borrower's bankruptcy and foreclosure history and borrower income and debt information. One thing that they did kind of tighten, actually, in the final rules compared to the proposal was putting in the exact borrower credit score as opposed to a range of credit scores, which had been in the original proposal. So those are some of the types of changes that that were made. In particular, that 5 to 2-digit zip code, according to a study by the SEC included in the final rules, significantly reduces the re-identification risk. They quantified it as moving from an 80% risk for 5-digit down to 20% or less for a 2-digit.
Quite a difference. Thank you, Steve. What will be some of the most important asset class specific requirements for the other asset classes then, Ned?
Sure. I think for, unlike in RMBS, I think the SEC adopted for CMBS something very close to the existing market practice, where for years the CMSA format has provided asset level data to the commercial mortgage-backed industry. With respect to resecuritizations, I think that it's going to be several years until we see that requirement coming into effect, because the original securitization that is then resecuritized won't require asset level data until the 2016 time period, when the initial securitization will have the assets required. So that leaves us with auto loans and auto leases. And there I think there are a number of significant changes from what historical market practice has been. First and foremost, of course, there will be disclosure of asset level data for those asset classes, which has not historically been generally available. But then within that context, I think issuers will need to be considering additional connections to not only their underwriting systems, where they'll now be required to indicate whether a loan met an original criteria during the first level of solicitation, or whether that consumer had to go through some escalated process, but as well as more information related to the vehicle than has been historically summarized, information related to the obligor, including, for example, the credit score, and then on an ongoing basis to remove the asymmetry of information between investors and issuers. If any party to the deal gets an updated credit score on an obligor in the deal, they would then be updating that field and providing that information to investors, as well as information related to the activity on the loan, things like scheduled principal and scheduled interest that, in today's environment where most, or if not all, of the U.S. auto loans are simple interest, are concepts that don't really reside in the normal servicing of the loan and the interaction and the accounting between the consumer and the securitizer. They exist solely for securitization purposes. With respect to auto leases, very similar to loans with a couple of additional informations, a couple of different pieces of information, rather, information around lease terminations and information about residuals. With that said, I think the punchline for both auto loans and auto leases are integration deeper into origination and credit systems, providing of fields that historically would not have even been aggregated to investors, and a set of work that really should begin now to identify the gaps between the fields that are going to be required and those which can easily be provided.
Thank you, Ned. And Steve, will issuers be limiting themselves to the required fields, do you think? Or are they going to be, investors going to be demanding more disclosure?
Great question. Thank you. I think it's not necessary for issuers to limit themselves to the required fields. The required fields basically provide this baseline that you can compare from deal to deal, apples to apples, but there's nothing in the rule that stops issuers from providing additional data fields, and we may well see that. In public offerings, of course, that would still constitute offering information, and as a result, it would be required to be filed with the SEC as a free writing prospectus, and therefore be publicly available. I think the tricky part will be, what if the issuers are looking to provide additional data fields that do contain potentially sensitive information or information that might increase the risk of re-identification. And that, I think, is something that will just take some time to play out. I think one potential outcome with that would be that issuers may determine that it's simply necessary to provide more granular location information, such as up to a 5-digit zip code, to investors that really truly do need that information in order to run their own models and make their own projections and effectively to do their own diligence, because there are some investors who I would believe would require that. And I think ultimately, to the extent that RMBS are going to be, in particular, are going to be offered in a robust way in the public markets, I could envision a process under which issuers look to get some sort of relief from the SEC, which would enable issuers on an optional basis to provide more granular data to investors that meet certain criteria for being able to use it, and without that data having to be posted publicly on EDGAR. That might actually just be an essential tweak to this in order to permit certain asset types to be in the public market.
Sure. Thank you, Steve. Ned, are the regulations going to require fundamental changes in how information is collected and disseminated? And what would the implications be for investors of that?
It absolutely will. We talked a little bit about some of the new regulations will be provided. But for asset classes like auto loans and auto leases, it's an entirely new paradigm for investors. So if you consider that the information in XML format is going to be publicly available through EDGAR, you also have to realize that EDGAR is a document-based system. It's not a database of data elements. So for an analogy, consider going to a public library. You can check out of the library for free all of the public XML files you would like, and you can do that as if it were a digital book as opposed to a print version. But there's still a lot of work to do to ingest those files you checked out. You have to files, develop programs to understand what that means, put them in databases, store that data, and so what this really suggests, even for sophisticated investors, concatenating the data, but also simply just to avoid the hundreds and thousands of dollars in data storage with competitive vendor costs, servers and hardware alone. This is a massive amount of the market, the material data. And lastly, of course, there'll be value services beyond just and putting the data in the database where that data will be pre-aggregated, managed to cache flow, etc.
Thanks very much, Ned. And what about the kind of system changes that industry participants might expect?
Well, we touched on initially a deeper integration for both origination systems, two of them, a renegotiation, if you will, with credit providers if you're going to use a FICO score, Vantage score, or an external credit score to make sure you get the license rights, even just to publish that data for this purpose. But also securitization-specific calculations that the SEC is now requiring that are not typically part of a receivable accounting system set of calculations. And perhaps one of the areas that we didn't touch on yet, but we'll talk about when we turn to shelf eligibility.
Fantastic. Okay, now we've covered loan level disclosure. Let's turn to one of the other areas that the SEC addressed in the new regulations, which is the removal of credit ratings from the regulations for shelf eligibility. Steve, very generally, what are the new shelf eligibility requirements?
Thanks very much. One thing to note is that these requirements do not include some of the original suggested requirements, such as risk retention and life of deal exchange. meet some criteria that set them apart from new or one-off issuers. It's essentially analogous to what in the corporate markets would be a reporting history of a public company, an established public company. But of course, for asset-backed securities, each individual offering is a new offering. So it does differ. Basically, the SEC added several requirements. The most important ones being the CEO certification and the asset review provision. There, generally, the CEO is required to, of the depositor, is essentially required to sign a certification, which, among other things, concludes that taking into account all aspects of the assets and the structure and the risks as disclosed, there's a reasonable basis trigger a review of the assets if certain triggers are met, and that will be a pool-wide review of assets by an independent reviewer called an asset representations reviewer. That party must be engaged up front at the start of the transaction, and the rule sets for certain kind of restrictions, kind of the trigger a asset level review. But ultimately, the triggering event is derived from a certain level of delinquency on the pool. So if the pool performs poorly, the review is triggered. Also, there must be a dispute resolution mechanism baked into the transaction, resulting in mandatory mediation or third-party arbitration of disputes, and there must be a mechanism for investor communications to be facilitated. And I think also importantly, along with these requirements for just being on a shelf registration statement, another very important new requirement that applies to ABS issued under shelf registrations is the concept of what's called a Rule 424H preliminary prospectus, and that is a complete preliminary prospectus containing everything other than pricing-related information that must be provided to investors and filed on EDGAR 3 days before the first sale of a security in the offering is priced. And that's a very significant additional component of what you need to do to be on a shelf registration statement.
Thank you very much, Steve. Ned, just picking up on something Steve mentioned there, could you tell us what kind of uncertainties will face depositor CEOs when they have to sign the required certifications, and how they might mitigate those risks?
Absolutely. Well, I think, first and foremost, the SEC proposed that the CEO had to be the one certifying. And there were, a lot of comments that the CEO, at least in the past environment, was not necessarily the person close enough to be the one who said, yes, this set of collateral and this cash flow are likely to provide the expected results. The SEC heard those comments and still said, no, we would like the CEO, or we require the CEO to be the person who authenticates that. So given that in many instances the CEO might not be coming from the securitization industry, the recommendation, I think, is twofold. First, I think it's important for CEOs. I think it's important first to realize that as long as the deal pays as expected, everyone will be happy and content. So we only have to consider an instance then when the deal does not pay as expected, and then what position would the CEO like to be in at that point? And I think there's two steps that that can be put in place to offer protections there. The first is that the authentication that the cash flow was run under normal and different stress scenarios and provided expected results. That's an output today that's traditionally run, but I would submit that it should be preserved in an audited environment with the appropriate certifications. As Steve mentioned, it doesn't. The requirement is not that it's a credit guarantee that the CEO says the deal will absolutely perform, but I think the more proof that can be offered that there was a rigor around validating the cash flow results at the inception of the deal, the better position to defend the CEO certification a CEO will be. And second, with regard to the asset pool itself, proof that there's an objective approach to determining whether the new pool is like or unlike prior pools, supported by statistical evidence. And I think that's one of the areas, particularly related to item 1105 disclosure that's addressed elsewhere, but I think it also applies in the area of CEO certification. If there were fundamental underwriting decisions or different product lines or other changes that make the current securitized pool different from prior ones, I think it's important that issuers put together a statistical and objective regime to kind of review and disclose that.
Sure, thank you, Ned. And how does the asset review provision work? How does it compare to the AUP that accounting firms undertake today or under Rule 193?
Yeah, thanks. The AUP would simply be an accounting firm doing a tape to loan file comparison prior to the issuance of the transaction, which is one of the components of a Rule 193 review. Rule 193, of course, for public deals already is in existence and mandates that an issuer do a review of the assets prior to an offering to make sure that they are properly described in the offering document. And that requirement really has been embraced not only in well, it's required in public deals, but it's been embraced in the Rule 144A transactions as well, where it's basically viewed that that type of pre-offering review and disclosure is a best practice. In fact, rating agencies mandate a certain level of pre-offering review, which is frequently conducted by third-party diligence vendors as to certain elements of that review. So the nature of the asset level review today, basically pre-offering, includes things like comparison to underwriting criteria, data accuracy, property value, and some things along those lines. The new asset review provision is different in a number of respects. First of all, the asset review mandated by the new rules is geared more towards whether a representation and warranty was breached that could require a repurchase by the issuer, which is a slightly different review than the pre-offering review. Importantly, many transactions are really, I would say all RMBS transactions today in the 144A markets already embrace a post-issuance review process. If a loan triggers past a certain delinquency threshold, such as 120 days, then that specific loan is mandated to be sent out for review by an independent reviewer who was not involved in the pre-offering review to determine compliance with reps and warrants, most particularly with compliance simply with the underwriting criteria and whether there's a basis for making a putback claim. So the market has already moved in the direction of adopting provisions that provide an asset level review post-issuance. But what we're seeing actually emerge in transactions is quite different than the Reg AB 2 requirement, because what we are seeing in transactions is a loan-by-loan review from day one in a transaction for any loan that passes a certain delinquency trigger or other individual loan event, whereas what's mandated under the Reg AB 2 is a pool-wide review only to take place if the entire pool performs at a level past delinquency levels, which is obviously a pool-wide instead of asset-by-asset review is quite a different concept.
How about the practical impact of the new requirement for an annual compliance check?
Well, one of the additional registrant requirements is that you have a clean 12-month history of having complied with these CEO certification requirements and the asset review in your transaction document requirements. But what's really notable about it is that they basically added it to the existing requirement for filing a shelf registration, that you as an issuer must have not failed to file any Exchange Act required filing during the past 12 months when you file your registration statement. So that's like monthly reports, annual reports, Form 8K reports for special events. Now what's been added to both of these is not just that that is tested at filing, but also on an annual basis. On an annual basis, the issuer must meet those criteria on a look-back basis. And I think what's really kind of most different about the net result of that is that it's possible for an issuer to lose shelf registration eligibility because they failed to file a Exchange Act report, during the course of up and running an effective shelf, which would not have happened under the old rules. You would not have retested that compliance once the shelf has been made effective.
Thank you, Steve. The SEC conducted a pilot program when it adopted the first Regulation AB. Now that they're proposing a pilot program for Regulation AB2, Ned, what kind of details on that pilot program do we have?
Well, I think for those watching the slides, the two key links, the one key link and the email to participate are right there on the slide. The SEC formally announced that they will be having a pilot program. They did this on October 6th, and there's a window for issuers and sponsors who wish to participate in that program. That window runs from 9 a.m. on October 20th through 5:30 p.m. on October 24th. The SEC is looking for 2 issuers per asset class, and it will be a first-come, first-served type of enrollment. So if you're thinking about or contemplating getting involved in the pilot program, doing so first thing on October 20th Eastern Standard Time might be a good idea. The details of the pilot program are still not fully hashed and vetted out yet. But the expectation that the SEC disclosed will be that issuers participating in this program will have a new draft registration statement ready for review around February in 2015.
Perfect. Thanks, Ned. We've mentioned a few of the key dates. As we bring up the next slide of all the areas impacted by the new regulation, let's discuss when the market should begin preparing for the various aspects of that regulation. What should an issuer be thinking about with respect to updating their legal documents, and will that differ for those in the pilot program? Steve?
Sure. Yes, I think the first thing to think about is, if you have an existing shelf registration as a ABS issuer, the first thing to think about is big picture, how you are going to be complying with these rules, and if there is some sort of element of rules that causes you to think that you may not even be in the public markets anymore, that's your first determination to make. If you determine that you are going to continue to want to be in the public markets as a shelf issuer, then you're going to have to get your shelf registration updated, because the new form, it's Form N, filing 6 months in advance of that, be ready to bring in their initial filings significantly earlier than that. of course, an important attribute of the program is that sponsors
on immediately.
From a timeline perspective, the very first thing I would suggest an issuer does is to perform a gap analysis between the required field elements for their asset classes and those that they've historically accessed, even if they haven't been providing loan level data for an aggregated format. If you're a first-time issuer, the same type of thing applies. Look at all of the fields that are required and see which ones you can't provide. Second, I would assume that originator systems and receivable accounting systems that weren't designed with securitization in mind won't be the likely way to fill those gaps. You will likely need a separate database and securitization environment to comply with the required field elements of the asset level disclosures. Beyond the asset level disclosures, the next thing I would recommend is developing a plan on how you're going to manage the reps and warranties tracking and other nuances of maintaining your shelf eligibility that could trip you up. Third in line, I would say, develop a system for the data integrity checks, because all of the fields are required. I think the market will eventually penalize issuers who don't provide all of the data in substantially a correct format. So having a process to make sure the data is of high quality is important. And that aspect exists in other regimes in Australia and Europe by the regulatory authority. But I think issuers here under Reg AB 2 will be ensuring the quality of the data themselves. Fourth in line then becomes some of the work on just making sure you can provide the required forms. Things like new item 1125, which introduces Schedule AL, which is the actual artifact that delivers the loan level data. And then lastly, I think you can worry about getting that data and the ability to publish it in an XML format, which I think once you've done the first steps becomes a much easier task.
Thank you very much, Ned. The clock is ticking on us slightly, but I would like to quickly fit in our second poll. From the options which will be appearing in front of you, how much does your firm anticipate spending to accommodate for Regulation AB2 between now and November next year? The options are, as you can see, are less than $100,000, $100,000 to $500,000, $500,000 to $1 million, $1 million to $5 million, or more than $5 million. Thank you all very much. The results of that will be available shortly. While we wait for those to come in, and with these changes in place, what is the outlook for US public and 144A markets?
Yeah, I'll take that first. I think focusing on Resi MBS initially here, I think my prediction is going to be that it's going to be difficult to do public offerings of our MBS because investors, I believe, will want more granular data about the assets, and most of the securities are sold to very sophisticated institutional investors, who are accustomed to having their own proprietary models and running their own information and assessing the risks, and I don't think they're going to be happy with the two-digit. And so ultimately, I certainly would hope the SEC would make an accommodation. I think I would hope that a movement in that direction would be well received by the SEC, because there are benefits to investors of being in the public markets. There are additional protections and benefits under the securities laws for registered deals that investors don't get in 144A. And I would hope the SEC would make an accommodation to permit investors to have those protections, but also get the information that the most sophisticated among them are going to need.
And I think that's one of the unintended effects that Steve mentioned, which is by adopting a regime that actually is perhaps less robust than the existing market practice, and at the same time leaving the 144A option open to avoid the loan level disclosure that was originally going to impact both public and 144A deals. I think that there's a risk that for the private label mortgage market that it really takes a step back and damages liquidity and the reach of the investor base that would be available in the public market. I think the story is a little less dire, perhaps, in the other asset classes. As we mentioned, CMBS is largely consistent with market practice. And I think that for auto loans, which don't have, for example, the two-digit zip, they'll be disclosing borrower information at the state level. I think the public markets are attractive enough that the big issuers are likely to continue to access the broader investor base and take advantage of the public markets. It's possible that some of the specialized finance companies or those who don't regularly issue in public may wait on the sideline to see how this takes hold. But I think that there's a likelihood that the SEC, in addition to looking at other asset classes that might require asset-level disclosure, may revisit the 144A loophole as well at some point in the future. And that might be the way that they close that gap.
Sure. Thank you both very much. Okay, the results of our second poll are now available. So if you refer to a panel in front of you, it's pretty clear that most of you are intending to spend or anticipating to spend less than $100,000. Thank you all very much. We are about to move on to the Q&A session, so if you've not yet submitted a question and you wish to do so, please do send those in now. Just before we do get to those questions, Ned, what are the issues that the SEC has left unresolved?
Well, as I mentioned, the initial proposal had 9 asset classes where loan level data was going to be required, asset level data. And it was very clear when Rolane Bancroft made her comments a couple of months ago, or a month ago rather now, that the Commission did not make a definitive determination that they were done with rulemaking around asset level disclosure. I think that the political pressure to get Reg AB 2 out the door and complete some measure of Dodd-Frank rulemaking necessitated the Reg AB 2 that we did get. But there's, I think, an open question with respect to student loans and equipment loans and leases, et cetera, and there will be, in my estimation, a Reg AB 3 which will address that aspect. In addition, I do think that the disclosure of a cash flow waterfall, there were a lot of comments during the period about what format Python was initially proposed as a language, or whether a programmatic disclosure was appropriate versus more descriptive language. And I do think that is another open issue that the SEC will likely conclude on. And then thirdly, as we just talked about, I think that the disclosure that the market may require, to the extent that it doesn't match with the SEC requirement, the SEC definitely dialed back concerns on consumer protection. As Steve mentioned, they got that letter from the CFPB that says the current rules, if the SEC requires the loan level disclosure, asset level disclosure for an investor to perform their own diligence, certainly was in line with the Fair Credit Reporting Act. But the problem that it creates for the market is now there's much less information available, particularly in RMBS, and how will the market react to that? I think there may be some additional rulemaking on that front as well.
Sure. Thank you, Ned. Okay, then finally, Steve, from your perspective, what do you see as the best and worst aspects of these new rules?
Well, I think the fact that they were not extended to Rule 144A was really, I think the best aspect of the new rule. I think that was very much the right decision by the SEC to be cautious with this rulemaking and to avoid harming liquidity and harming the markets. A number of the commissioners spoke at the open meeting about the need to give the markets time to react to these rules as they came out before moving on and considering further changes. And while Reg AB 2 is certainly a very big step, I think it's a very measured step, very responsible step, and that going all the way into 144A, I think, from the get-go, I think, would have been very disruptive, and so I'm glad that they did not do that. And I think another really good aspect of the rule that we didn't talk that much about on this call is that investors are going to have more time to look at information. You know, that 424H requirement for the full preliminary 3 days ahead of pricing, that's very significant. And that's definitely a benefit to investors. At the open meeting, they basically said there were 3 important things that the rules were accomplishing, and investors having more time to digest information was one of the 3. So it's certainly a big benefit. And I think an additional thing to keep in mind is that while literally the rules have not been extended to Rule 144A, practitioners in the space, you know, certainly do look to the public rules for guidance as to best practices and as to materiality. And I think that as a result of that, we'll probably see some effect in the 144A market in terms of getting disclosure documents to investors earlier in the process. What's the worst aspects of the new rules? I think that the one-size-fits-all kind of approach of what data should be provided and that it should be provided freely and available to the public is, while a noble, certainly objective, I think just doesn't really fit that well with these particular markets because there are investors who simply do require further granularity of disclosure.
Steve, thank you very much. We have had a few questions in. We're going to try and fit as many as we can. In fact, Steve, if I ask you the first one here, it's about the 5-digit zip code. The question is 2-digit zip code a minimum requirement or a maximum requirement? And to the extent that an RMBS issuer wishes to continue disclosing loan-level 5-digit zip codes, will that make them considered non-compliant?
Well, I think if you want to comply with the rule and do a public offering, then you have to do 2-digit zip code reporting in your public filings. So it's not a maximum requirement, and it's not a minimum requirement either, in that you would have to have that field in your report. If you're sure and you feel investors want more granular data and you want to provide it, you're really going to have to consider the privacy aspects of that and consider what potential exposure or liability there might be to privacy concerns in providing that information, and recognizing that the CFPB letter provides protection only if you are providing the disclosure needed to meet the regulatory mandate, which is only the 2-digit level. So you would need to consider other ways to mitigate that risk, I would think most importantly in the area of undertakings by investors to hold the information properly.
Sure. Thank you very much. Ned, we've had a couple of questions about FICO. So if I could ask those to you. First of all is what FICO model is being used, and we've also been asked how a FICO score is allowed to be shared without a redistribution license from FICO.
Okay, let me answer the first question, which is with respect, and even though each asset class has its own field level requirements, there's consistency around information related to the obligor, and there are 2 fields. First, the obligor credit score type, and in that field you specify the type of standardized credit score used to evaluate the obligor during the loan origination process. And the second is the obligor credit score, what was the actual score from that process. So the SEC clearly is not mandating any particular score. So, for example, FICO is a separate company that develops models about consumer credit quality, and some asset classes and some issuers use that in their business. Vantage Score is similar in that they provide consumer credit quality scores, and Vantage happens to be owned by the the 3 consumer credit bureaus in the U.S., and those are Equifax, Experian, and TransUnion. So to get to the second question, the actual parties that license credit scores are the credit bureaus, and whether they use FICO, Vantage, or other prior or existing methodologies is up to each issuer to disclose, because they do have that flexibility when they disclose the obligor credit score type to choose, whichever model they're using, including perhaps an internal model.
Sure, thank you very much. We've got time for one more very quick answer to this final question, if possible. That is why there's been so much emphasis by the SEC on re-identification risk.
Well, I'll take a quick stab at that. I mean, I think basically it was because it was really brought to their attention in the comment process by commenters. One of the most notable ones, the World Privacy Forum, that brought that in back in 2010. And so I think that really the proposal and the commenting period just simply shone a very bright spotlight on those practices and made it really necessary to consider, those risks and how they should be addressed.
Sure. Steve, thank you very much. As we are running short of time, I will now bring this webinar to a close. I'd like to thank Ned and Steve very much for their insight on this topic, and thank all of you who have dialed in and taken part. A link to a recording of the webinar will be available on the SCI website shortly. If you have any further questions, please contact us via our website, www.structuredcreditinvestor.com.